Upstream Support Trust planning is an innovative and effective planning tool developed by Kelleher and Holland attorney Ed Morrow. Also known as UST or simply Upstream Planning, this planning tool is aimed at achieving a step up on low basis in trust assets. The upshot of Upstream Planning is to establish a trust for your family in which low basis assets are intentionally made includible into the taxable estate of another person, often a friend or relative who is older or in declining health, so that upon their passing, the adjusted basis of the assets are stepped up to the new fair market value, thereby saving capital gains taxes on later sale or increasing depreciation deductions if it is depreciable property. There is typically a cap on how many assets this can apply to, based on the upstream beneficiary's applicable exclusion amount. In other words, you can use the other person's unused estate tax exemption so that the trust for your family's benefit can obtain the step up in basis upon the person's death. By reversing the conventional flow of estate transfers and capitalizing on the shorter life expectancy of others, UST planning can significantly reduce income and capital gains taxes. UST planning offers substantial advantages for both single individuals and married couples when incorporated into traditional irrevocable trust strategies, such as spousal lifetime access trusts or irrevocable grantor trusts. This method is unique as it not only minimizes estate and transfer taxes for beneficiaries, but also grants the persons doing the planning with significant tax reduction benefits to enjoy during their lifetime. This way, the persons doing the planning can reap the rewards of UST planning and not just their children and other loved ones after their deaths. Let's use an example to illustrate UST planning. Many years ago, Jane purchased a publicly traded stock for $150,000. Over time, the value of the stock rises significantly, resulting in potential capital gains exposure should Jane choose to sell it. To mitigate this exposure as well as save on estate taxes for her family, Jane establishes an irrevocable spousal lifetime access trust, otherwise known as a SLAT, primarily benefiting her husband, with secondary benefits for her children and other descendants, as well as a beneficial interest for her father-in-law. The SLAT incorporates UST planning provisions that ensure the stock is included in her father-in-law's taxable estate upon his death without triggering estate taxes. Her father-in-law resides in Florida with a net worth of $1 million and a substantial 2026 federal estate tax exemption of $15 million. Now suppose that her father-in-law passes away next year with the stock in the SLAT valued at $1,165,000. As intended, the UST provisions in the SLAT result in the $1,165,000 stock being deliberately included in her father-in-law's taxable estate. Consequently, for capital gains tax purposes, the stock's basis is stepped up from the original purchase price of $150,000 to the date of death value of $1,165,000. And since her father-in-law's total taxable estate, including the stock in the trust, is significantly less than his remaining 2026 federal estate tax exemption of $15 million, no estate or transfer taxes are owed by his estate at his death. Importantly, the stock remains in the SLAT, primarily benefiting Jane's husband and secondarily benefiting their descendants, as originally planned. The powerful capital gains advantage of UST planning is realized when the SLAT sells the stock, potentially as soon as the day after her father-in-law's death, for $1,165,000. Thanks to the stepped-up basis, there are no capital gains taxes owed on the sale, resulting in substantial savings on over $1 million in capital gains. This strategic application of UST planning saves Jane's family a considerable amount in capital gains taxes and showcases the brilliance of thoughtful estate and tax planning. Another huge upside is that the stock and other assets in the SLAT are also estate tax and generation skipping tax-free. Just another Kelleher and Holland solid capital gains, estate, and generation skipping transfer tax planning result. The savings can be much larger with assets like depreciated real estate using leverage. At KH, our law firm is committed to protecting our clients. If you desire assistance or have questions, please contact me or any one of our estate planning attorneys or visit our website for more information. See you next time.